Hello, good morning. I am Avnish Jain. Welcome to the monthly debt outlook from Canara Robeco. As usual, let's start with the global happenings. Global situation, geopolitical situation continues to remain volatile. As expected, Trump came out with a slew of tariffs on 2nd of April, which he promptly took back about a week later. Though the US government has removed or delayed tariffs by 3 months for other countries, China remains in the spotlight with the highest tariffs of 145%. This has led to large imports being cancelled from China and prices going up in the US. However, President Trump continues to play his tariff game and he expects countries to come to the negotiating table with better trade deals. India is expected to be the first ones to sign a trade deal with the US in the next couple of months, while Japan and the European Union are also looking to sign long-term trade deals with the US. In terms of rates, US rates continue to remain a little volatile. There was some concerns on recession happening because of tariff pressure, but till now there are not many signs of that to happen. The US 10-year yield generally was range bound between 4.20 to 4.40, and rest of the market also was oscillating between high apprehension of recession. With the data coming out as good, the market was actually in a limbo. Oil prices fell because of China going into slowdown and further slowdown because of US tariffs. So we would see in the near future China struggling to get a trade deal with the US. While US has been reaching out to China to start trade deal negotiations, China is not ready right now to talk directly to the US. There have been some low-level meetings between trade representatives of both US and China, but the efforts by the US president to directly talk with the Chinese premier have been rebuffed, as China wants that there should be some semblance of trade understanding before they start negotiations. So the tension between US and China continues on tariffs, while on the background we have Ukraine and Russia war, which also is on the forefront. President Trump has tried his level best to get them on the negotiating table, but he also seems to be losing patience with Vladimir Putin of Russia. While there have been news of some ceasefire coming and going, but there have no been concrete results on the ground. All these things have put markets in a kind of limbo, and markets have been extremely volatile, especially if you look at equity markets. While markets have recovered after US delayed tariffs to rest of the world except China by 3 months, there is a lot of undercurrent still in the market. What will happen in next 3 months, nobody knows, and markets could react adversely if things don't go well. In terms of India, India stands out as a country where tariff impact is minimal. Also, India is the first one to start negotiating very aggressively with the US, and there is expectation that there will be a trade deal done by second half of this year. The visit of US Vice President Vance also raises hope of an early trade deal. In his speeches also, US Vice President Vance has also pointed out that the trade deal was near completion. That will be good news for India and Indian markets. Oil prices being down because of global slowdown fears as well as China deflation is very positive for India. Inflows into Indian equity markets have led to rupee falling to less than 85 rupees per dollar and crossing 84 rupees per dollar as well today. So there's been a sharp reversal in rupee value where it touched a high of about 87.98 in early part of March, and now it is trading around 84 to the dollar or lesser. In terms of rates, situation continues to be extremely good. After February rate cut, market did not react too well because of liquidity pressures. Liquidity was extremely tight due to intervention by RBI in the previous months to support the rupee when dollar was extremely strong. After February, RBI took the efforts to inject liquidity in the system via open market operations, USD INR swaps, as well as longer term variable rate repo auctions. RBI's main tool now seems to be open market operation purchases, where they buy gilts directly from the market, which injects liquidity into the system. Till now, RBI has almost completed 2.45 lakh crores of open market operations and already announced 1.25 lakh crores more for May. RBI seems to be going the way of excess liquidity, which also the governor announced after the rate cut in April as well, that since the stance has changed to accommodative, they would like to go to a liquidity surplus, which will be net 1% of net demand and time liabilities. And that already the system liquidity is good. Short-term rates have fallen faster on back of liquidity and rate cuts. Rate cuts were done in the last two policies of 25 basis each, bringing repo rate to 6%. Money and T-bill rates have fallen to below 6%. And even if you look at 2-3 year G-Secs, they are around 605, 615 range. Clearly, market is discounting further rate cuts in the incoming months or policies. We do anticipate one rate cut in June happening and also another rate cut happening in August, bringing the total rate cut in this cycle to about 100 basis points. Market is also pricing similar rate cut actions, and because growth is a little bit moderating, while inflation has fallen dramatically. Inflation, if we look at the last number, was only 3.3% against a 4% target by RBI, which validated RBI's stance of cutting in February and in April, and also going in for liquidity measures to support the economy. World economy is expected to slow down on growth to probably around 2%. India will have to depend on the domestic demand to meet its growth target. To that extent, RBI has to provide liquidity in the system to ensure that the rate cuts which they are delivering get passed on to the ultimate borrower. This will help corporates to look for expenditure, capital expenditure, as well consumers to be able to spend more as rates drop and interest rates go lower. And we will see the disposable income of people also being used for more consumption. Going forward, RBI is expected to cut rates. At this juncture, we anticipate about 50 basis rate cut, more. However, there could be more rate cuts depending on inflation trajectory as well as growth slowdown. If RBI perceives that growth is slowing down faster and global growth also is having a negative impact on overall Indian growth story, RBI may move for more rate cuts in the second half of the year. Liquidity has already turned very positive, which is again very good for corporate bonds as well. Corporate bond rates are also coming down fast, and we expect that funds having corporate bond exposure should continue to do well in the coming months. 10-year government bond yield fell to a low of 6.3% after the rate cut and now is trading between 635 to 640 range as markets digest the further news which is coming in from global as well as local channels. The India-Pakistan standoff has put some sort of uncertainty in markets, but till now we have not seen any escalation in hostilities. So we would anticipate that there could be some reaction if that happens. As of now, we don't see any major reaction on markets, especially the debt markets. However, even if there is some escalation, we expect that RBI will be proactive in injecting further liquidity in the market to ensure the orderly functioning of the financial markets in times of crisis, which they have done in the past also. So that again would be beneficial for bond markets. Overall, we anticipate that rates will continue to drift lower in coming months as rate cuts are delivered. For investors, considering the liquidity situation, short-term funds provide a good option for investing for 6 to 12 month horizon, like the savings fund and the short duration fund. For long-term investors who can take the volatility and risk, gilt fund, dynamic bond fund are again good options to invest, wherein long-term bond yields are still on the higher side and any compression in yields could provide alpha to the investors over next 1 to 2 years. As always, investors should look to invest looking at their risk profile and their investment horizon. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.